What we saw in earlier examples was that the temporary differences were created, and these temporary differences were created because of two expenses which we had discussed. One was the depreciation expense that resulted in a creation of deferred tax liability, and we have also discussed an expense called warranty expense, and this led to the creation of deferred tax asset. They were called as temporary because they got reversed over a period of time. Now there are some differences which are called as permanent differences. Now these differences do not reverse like the way we saw in the temporary case. Now as we have understood that there are two kinds of income statement, one for the shareholder and the other one for the tax authorities. Now there are some examples of income and expenses which do not reverse. Say for example, there is a tax exempt interest from municipal bonds. Now what happens in this case is that it is included while we report in the income statement for shareholders, but since these are tax exempt, it is not reported while we talk about the income statement from tax authorities. Likewise, on the expense side, you can think about insurance premium that has been paid. Now here these expense is included in the income statement for shareholders, but it is not allowed to be included here. Likewise, there could be an example of tax credit. These tax credits, you'll find that these are not taken on the income statement from shareholders, but they are found in the income statement for tax authorities. So what happens is that essentially permanent difference comes where these expenses or income only show in either one of the income statement, but not on both. So let's take an example and see what happens when these are the situations which are presented. So we'll start with, let's say, sales, and we'll draw two income statements for shareholders as well as for the tax authorities. Now sales, let's assume that this was 1000 here, and obviously this is 1000 here. Cost of goods sold, let's assume this is 500 and 500, so there's no change here. Gross profit will come out to be 500 in both the cases. Now let's introduce these permanent expenses or permanent income here. Let's introduce the interest from the municipal bonds. Now when it is about interest from municipal bonds, it is only considered in the shareholders, it is not included in the tax authorities. So I'll write this number as 100, which is the interest from municipal bonds which you may have received, and it is not included here, so this is 0. So what you'll get is 600 here, however it will be 500 here. Now let's take the insurance premium. This insurance premium, let's assume this was 50 as an expense, and again as we saw earlier, it is not allowed in the tax statement, so it will be 0 here. So what is the net earnings before taxes? The earnings before taxes in this case will be 500 plus 100 minus 50. This comes out to be 550, and in this case this is 500 plus 0 minus 0. Anyways, it comes out to be 500. Now let's assume that taxes were at the rate of 40%. So how much taxes are you going to pay in the income tax? Now let us calculate how much taxes do we need to pay when we are looking at the income tax authority income statement. So this would be 40% of this 500. This comes out to be 200. However, when we talk about the income statement from the shareholders point of view, the tax would come out to be 40% of this. This is equal to 220. Now one thing that we must kind of understand is that this income statement here, which is reported to the shareholders, actually include the permanent differences. These are only reflected in the income statement of the shareholders, but not in the income statement of the tax authorities. So when we talk about 150, this comes out to be 50, and if you look at the tax associated with this additional 50 would be equal to 20. So what we essentially show in the income statement to the shareholders is that we don't include this 20 because this is the result of the permanent differences. So here we directly take this number, which is 200 here, and show it in the income statement, so that your net income or the profit comes out to be 250. So what is our effective tax rate when we have shown 200 as compared to 220? The effective tax rate here will come out to be 200 divided by 550, that is the pre-tax income. So this comes out to be around 36.3%. And what is the effective tax rate in the IT case? That is 200 divided by 500. So this comes out to be 40%. So as we note here that the effective tax rate is lower in this case because of the presence of the permanent differences.